This is Book Group 7, The Big Short, and we will be talking about 2008 subprime mortgage crisis and corporate bad behavior. We will be starting by talking about the occurrence process, so how did this all happen? And after that, we're going to talk about the corporate bad behavior and the signs of crisis. At the end, we're going to talk about the outcome, so the impact and compensation / bailouts for the Wall Street executives. So everything started with investors wanting to find profitable area to invest. The mortgage bond was around, but investors did not want to participate because borrowers could pay up anytime they wanted, meaning they would repay the loan when the interest rate fall, and then refinance with the lower interest rate. That means investors would get the money back when they did not want it, so they had no reason to invest, until the Salomon brothers came up with the trench system. So what is trench system and how did that work? So first, investment banks would buy a huge number of mortgages from the lender and then gather them into trenches with 3 different sections. The third floor of the trench would be considered as safe investment with good ratings, and the investors would have lower chance of losing their money. But because of that, they're going to have a lower interest rate. The second floor was considered relatively safe with mediocre ratings. And because of that, they had fair interest rate. The first floor was considered very risky with low ratings. That means investors had higher chance of losing their money. But because of that, they also had higher rate of return. And this whole thing was called the collateralization debt obligation, also known as CDO. So first off, the banks would buy the mortgages, and then they're going to gather them together, and then set them into different sections of trenches. So third trench, the ones with the good ratings. Second trench, mediocre ratings. And then the first, and this were considered the bad rating mortgages. Again, this whole thing was called CDO. And then the lower you go, there was a more chance of you losing money. But because of that, you also get to enjoy higher rate of return. Now, what was the problem? At first, this wasn't the problem. Investment banks would sell these trenches to investors, and investors invest according to their taste and prospect. So if you want to play safe, then you would go for the third trench. But if you were a risk taker and wanted to go for that one big shot, then you would invest in the first trench. But the problem occurred when the investors wanted more mortgage bonds. They thought homeowners would never not try to pay the mortgage loan, so they thought the mortgage bonds were relatively safe. So in order to keep up with the demand, investment banks tried to buy more mortgages, but they couldn't because qualified people already had mortgages. And when I say qualified people, I'm talking about people with stable jobs, earning enough to support their families, and people who are responsible with their money. So what the lenders decided to do was they started to give mortgages to people who should not be qualified. So these are the people with maybe no jobs, or maybe they're not making enough to support their family, or they may not be very responsible with their money. And this type of mortgages was called the subprime mortgages. Obviously, people started to default, not being able to pay the loans. Now banks are left with houses with nobody to buy them. So there was excess supply of homes with not enough demand to accommodate. Obviously, because of that, price of houses dropped and people started to sell their houses because it didn't make sense for people to pay expensive mortgages when the value of their house started to go down. Now, investment banks are left with many houses of decreasing value. Obviously, investors will not invest. And if the investors do not invest, banks cannot pay back the money that they borrowed to buy all these mortgages. And mortgage lenders cannot sell the mortgages. Now everything froze up, and eventually every financial institute was bankrupt, naming the 2008 subprime mortgage crisis.
So subprime mortgages. The housing market and mortgages was one of the biggest markets in America. Since there was only so many people who had jobs to afford houses, it made the market smaller. When Ames Financial went public, they offered people subprime mortgages. Subprime mortgages were given to people who had hard time getting credit due to the risk they showed. The loans were packaged and sold as mortgage bonds almost immediately. At first, interest rates were low, so it could be easy to pay off. But later on, they increased, doubling it, making it difficult. So next, it shows a graph how subprime mortgage rates spiked from 2003 to 2009. Corporate bad behaviors. Corporate bad behavior in subprime mortgages. The subprime mortgages were risky and had a high default rate. To meet the demand of investors and banks, lenders approved excessive number of subprime mortgages. The return rate to investors was well below the level that should have accompanied the risk. The subprime mortgage lenders made it look like they were gaining money, when in fact the only capital that was made was on the loans that were destined to go bad. There was a boom in subprime mortgages that would lead to the fail of stock market. This really illustrated bad behavior because although companies knew that mortgages were set up for failure, they still took advantage of people and still sold them. People started to catch on to this and started to bet on credit defaults.
Corporate bad behavior was also demonstrated through CDOs. Goldman Sachs created many collateralized debt obligations, or CDOs, to counteract the credit default swaps. They rigged the system to make the triple B bonds look like they were triple A bonds to make it look like a safe bet. Since they were a well-respected company, many companies like AIG Insurance bought many CDOs. The CDOs made risk look minimal, but by creating a diverse portfolio that only existed on paper. It was later proven that it was actually impossible to figure out what was really in the CDOs. When the bonds started to lose a lot of their value, the price of the CDOs that the bet against the CDSs stayed the same. Between February and June 2007, when the bonds were subprime mortgages, lost about 30%, over $50 billion of new CDOs were sold. This was Wall Street raising the prices to make as much profit as they can from a failing market. Rating agencies turned a blind eye, allowing this to happen, instead of alerting the public by reducing the rates of the investments. AAA CDOs had actually not been sold at all. Instead, the banks held on to them. Another example of some corporate bad behavior was through Michael Burry's actions. Michael Burry started Scorn Investment to invest people's money. Once he caught on to the subprime mortgages, he looked into a way to bet against them, which turned out to be the credit default swaps. Michael took his investors' money without them knowing and started to invest in the credit default swaps. Once the investors caught on, they wanted their money back and started complaining. But Burry side-pocketed all the credit swaps, effectively freezing investors' assets as they could not pull out their money. Burry refused to comply with investors, even being threatened to be sued by many. Even though he was right, this is bad behavior by taking people's money and freezing their assets.
So the outcome of the whole situation of subprime mortgages and CDOs was that eventually CDOs started losing value to all the defaults of the underlying mortgages. The public was not aware of it due to the fact of the improper rating by the bond agencies, resulting in huge losses to both banks and the public. The banks were so exposed thanks to the credit swaps that they started losing huge amounts of money. Soon the whole world economy started collapsing as banks were no longer able to provide financial support to the economy. The Dow Jones was at its lowest point in over 4 years, and the stock markets all around the world soon followed and crashed, and a world recession followed. A bailout was needed to keep the banks and the financial industry afloat. Hundreds of millions of dollars were given to banks in an attempt to save the financial industry. In total, over $900 million was given to Wall Street, with 85 million going to AIG and other Wall Street banks to pay off for the losses created from the credit default swaps. Instead of helping support the economy and prop up the banks, most of the funds were actually paid out as bonuses to managers and executives responsible for creating the financial meltdown in the first place. In the end, only one person was ever sent to prison or convicted over the whole situation, and everybody responsible was let go free. The result was that the public was the one that ended up having to pay for the whole bailout.
And that concludes our presentation, and thank you for watching.